All right, welcome to The Explainer. Do you ever stop and think about what it actually takes to keep the lights on? I mean, really think about it. It's not just about power plants and wires. Nope. Behind the scenes, there's this incredible high-stakes financial system that's running 24/7. So today, we're going to pull back the curtain on these invisible markets that power pretty much everything you do.
Okay, to get our heads around this, let's start with a little thought experiment. What if you had to use every single drop of gasoline the exact moment it came out of the pump? No storing it in your tank, nothing. It goes from pump to engine, instantly. Kind of impossible, right? Just wouldn't work.
Well, believe it or not, that's the daily reality for electricity. It's the one thing we really can't store economically on a massive scale. So unlike, gasoline or water or pretty much any other product, it has to be produced and consumed in the very same instant. There is no giant warehouse full of electricity just waiting for you to flip a switch.
And that one simple fact, that constant, second-by-second balancing act between making it and using it created one of the most complex and honestly, one of the most vital market systems on the entire planet.
All right, so let's dive into this core problem. We're calling it the electricity dilemma.
So how do you solve a dilemma like this? Well, the system doesn't rely on just one market. It actually uses three completely distinct ones. You've got the spot market, which is all about the here and now. Then there's the forward market, which is for planning ahead and locking in prices. And finally, you have the options market, which, well, it's kind of like a super flexible insurance policy. Each one has a very specific job to do across a different slice of time.
A really easy way to think about this is with a weather analogy. The spot market, that's like today's temperature. It tells you exactly what's happening right this second. The forward market, on the other hand, is more like the weather forecast. It's what helps you plan for the days and weeks ahead.
And to finish off that analogy, the options market is basically your hurricane insurance. You really hope you never have to use it, but man, if a financial storm hits, like a crazy unexpected price spike, you'll be so glad you have it.
So if you put it all together, each market has a super critical, specialized role. The spot market is like the system's real-time pulse, telling you what's up right now. The forward market is the stabilizer, giving everyone some much-needed predictability. And the options market, that's the safety net.
Okay, so we have these three markets, but how do they actually work together to predict and manage a future that is, let's be honest, deeply uncertain?
Yeah, here's the thing you've got to remember. The future isn't one single point. We can't know the exact price of electricity 60 days from now. It's just impossible. But what we can do is simulate thousands, even millions of potential futures based on everything we know today.
And that's what this cone of uncertainty shows so well. It's a picture of all those possibilities. It maps out the probable path for future prices, and you can see how it gets wider, more uncertain the further out you look. That shaded area basically represents the vast majority of the most likely outcomes.
So, how in the world do you plan for anything with all that uncertainty? Well, that's exactly where the forward price comes in. It kind of slices right through the middle of that cone, giving both the power generators and the big buyers one single agreed-upon number. It's the market's best guess that they can use to actually run their businesses. Okay, let's make this a little more real. Let's imagine you're the owner of a brand new solar farm. How would you use these tools to manage your risk and, actually stay in business?
So, as our solar farm owner, you've basically got three main strategies, or hedges as they're called, to protect yourself from crazy price swings. Strategy 1, go unhedged. You just roll the dice and sell your power for whatever the price is on the day. 2, you could use a forward contract and lock in a guaranteed price right now. Or 3, you could buy an option, which, remember, is like that price insurance. Now, if you go with that first strategy, staying unhedged, your potential revenue is, well, all over the place. I mean, you might get lucky and hit a really high price, which would be amazing, but you could also get a disastrously low one that could put you out of business. It's a complete gamble. But now look what happens when you use a forward contract. See how different that is? By locking in a price ahead of time, you've massively shrunk your risk. All the possible outcomes are now squeezed together around one predictable number. Sure, you're not going to have any massive surprise wins, but more importantly, you're not going to have any massive business-killing losses either.
And then there's the third way, using an option. And this is pretty cool. It does cost you a little bit of money upfront, that's called the premium, but it acts like a safety net. See how it just chops off all those worst-case low-price scenarios? But, and this is the key part, it still lets you cash in if prices happen to go through the roof. It's kind of like the best of both worlds, but you have to pay for that privilege.
This table really brings it all home. Just look at the standard deviation column. That's really just a fancy way of measuring how risky or volatile each strategy is. See how unhedged is by far the highest? Super risky. The forward hedge, the safest. And the option sits right in the middle. It really lowers that value at risk, which is basically your worst-case scenario loss, without totally giving up on that potential for a big win.
So, okay, we've gone through all this complexity. What's the big takeaway? Why does any of this complex financial stuff actually matter to you? Well, it really comes down to this. This whole multi-market system, it's like the invisible architecture that lets our power grid be both efficient today and stable tomorrow. It makes sure we have the power we need right now, while also giving investors the confidence they need to build the power plants we're all going to need in the future.
So let's just boil this down to the key points. Forward contracts, they're the workhorses, they tame the volatility. Options, they're your essential insurance policy against disaster. And choosing the right strategy is always a balancing act based on how much risk you're willing to take. And remember, these aren't just numbers on a screen. These are the tools that keep our physical power grid from falling apart.
And that leaves us with one final big question to think about. As we move towards a grid that relies more and more on renewable energy, wind and solar, it's going to get inherently more unpredictable. Because you can't just tell the sun to shine or the wind to blow, right? So in that kind of future, which of these tools is going to matter most? The stabilizer or the safety net?